We have the pleasure of our investment team presenting, and our youth group team lead, Gabriella Gill, is back talking to us about investments. Tonight, Gabriella Gill is presenting on investment basic stock options. So without further ado, let's get started, Gabby. Thank you so much for presenting to us tonight. We're looking forward to it.
No problem, no problem. So, my name is Gabriella Gill. I think I know everybody here, most people here. If you don't know me, I am the daughter of Annette Gill, the co-founder. I also, I guess a little background, I'm currently working in the mortgage world. So if anyone is interested in or looking to purchase a home or to refinance their home or to do a reverse mortgage or anything like that, I know it can be a daunting process. So just let me know if you need any help, and you can get to me through Messenger. So anyway, on to the actual presentation. Let me share my screen. Okay, so I gave a presentation the last time. It was just on the basics of the stock market. This time we're going to go a little deeper into stock options for beginners. First, I want to say that the stock market involves substantial risk of loss and is not suitable for every investor. The valuation of futures, stocks, and options may fluctuate. If the market moves against you, you may sustain a loss. You are responsible for all the risks and financial resources you use and for the chosen trading or investing system. You should not engage in trading unless you fully understand the nature of the transactions you are entering into and the extent of your exposure to loss. If you do not fully understand these risks, you must seek independent advice from your financial advisor. I am not a financial advisor. So I just want to make that very clear before we start. I'm here sharing just things that I've learned with you all. So let's do a little review for those of you who may not have been here the last time. Can anyone tell me what the stock market is? No.
It's a place where you can, the stock market is a place where you could buy into ownership of certain companies, commodities, services. I mean, I guess companies.
Right. So you buy shares of a company, which makes you partial owner, and you can also trade with other people. So if you want to buy one and someone wants to sell one, you can do all of that. So more than a physical place, it's really actions of buying and selling into different companies. So how can you make money investing in the stock market? I spoke about a few ways that you can do it the last time, but one of the easiest ways, if you just want to make money and you don't really want to have to pay attention to the way that a stock is moving constantly, is long-term investing. Long-term investing is basically where you study up on a stock, you think that it has the potential for growth, and so you buy it at a price and you just let it sit and you let it grow for a certain amount of time. And when you're ready, you can pull it out and you can take your profit. Long-term investing is usually 3 years, 5 years, a lifetime until the next generation. You can decide how long. And it's easy because of course, you have to initially establish if it's a good buy or not. But for the most part, when it's moving up and down, you don't really have to worry about it because you have the faith that you studied properly and that it is going to eventually make money. Another way that you can do it using the same thing is dividends. So basically, these stocks, some of them offer dividends, which is like a gift that they give you, that the company gives you for sticking with them. So every so often, they will give you a certain percentage of the earnings. So everybody that has a share will get some money. This is a great way to make money because unlike simply buying and holding a stock, you get instant results. So When you buy and hold a stock, you don't get the money until you pull out. But dividends, if they give you a certain percentage of money, it's yours to utilize right away. And so, for example, if you have random number like $100,000, and instead of putting it into the bank, you put it into a bunch of dividend stocks, then they'll give you a percentage of that money, of the money that they earn, and you can utilize it and you can make much more money. Because when you put it into a bank account, one, you're not going to get a lot of return on interest, and two, you also are not going to like, as inflation happens, your money is worth less and less. Whereas if you put it into these stocks that are going to grow, they'll do well, you don't have to pull out right away, and you can make money. So there are people who have, let's say again, $100,000 in the stock market, and every month off of the dividends, they're making $2,000, $3,000, $5,000. And so they're literally getting a second salary just from putting their money into dividend stocks instead of the bank, which I know not everyone's going to want to do because it's not, quote unquote, as safe as a bank account, but it's something to think about. It is a way that you can make money. Then we have, so if you do long-term investing, basically long-term investing is, let's say you purchase right here. As the stock moves, you basically ride the wave of the stock. And so when it makes this sharp drop to the bottom, you don't have to worry about it because you're trusting that eventually it will go up. You can do short-term investing, which is basically you buy here and you think that it's going to go up to here, and when it gets to here, you sell it. And so you don't have to be stressed about this downward movement. Or you might buy here and then you have to be stressed about this entire downward movement. So it's just a shorter term. And people do that because you can make money faster. So you can leave it in for a week, a month, 3 months. And then, for example, if you left it in for a couple months here, you would make much more money than you did right here. And you get the money right away and you can do whatever you want with it. But what we're talking about today are stock options. Stock options are much more volatile. They're a little harder sometimes because they require a lot of work. So you have to really know what you're doing if you're going to get into the options game, because again, you're not holding it here and letting it ride, and you're actually not even buying a stock in the first place. So let me explain. What is a stock option? Does anyone know what a stock option is before I dive into it? No? Okay. So a stock option is a, sorry?
I said, that's why we're here.
Oh, okay. So a stock option is a contract that gives the buyer the right, but not the obligation, to purchase 100 shares of a company's stock at a preset price known as the strike price within an agreed upon time. You purchase it when you believe a stock will move in a certain direction. Does that make sense? No. Okay. So let me explain in layman's terms, right? Basically, if you do your due diligence and you study a stock and you say, hey, such and such a stock, I don't know, Nike, is at $5 right now. And I'm studying it and I know that Nike stock can hit $10. And so because of that, it's like a bet. I'm betting that it's going to hit $10. And so when you purchase a contract, basically the contract is going to say, one, it's for the Nike stock, two, that you think that it's going to hit $10, and three, there's an expiration date. So it's not just infinite. You think it's going to hit $10 by a certain time, right? And so you purchase a contract that establishes that. And when you purchase that, it gives you the right to buy 100 shares of a company's stock. Why is that important? How can you make money off of that? So again, if it's $5 and you say, I think it's going to go to $10, and before it expires, it goes to $20, you have the right to purchase 100 shares at the price that you thought it was at $10. So you're automatically in profit. If it's at $20 and you bought it for $10, you have 100 shares. So for each share, right, that's $10 extra per share. So 10 times 100. Does that make sense? No? Should I clarify more?
Someone, Chief Anna saying she sees it as a way of legitimizing gambling. Well, I mean, if you could explain it, like break it down a little bit more, because you're saying if it goes up to $20, then you double the profit. Is that what you're saying? You have the right to do it, to purchase it. You purchase the same amount of stocks up to $10. I don't understand.
Right, exactly. So it's at $5 and you think it's going to go to $10, right? And if it goes above that, it now costs $20, but you have the right to purchase it for $10. So you're buying it way less than everyone else on the market. And automatically, once you buy it, it's going to be worth $20. You just bought it for $10. So if you want to sell it, if you want to sell them right away, you have instant profit. Right? And I hear what she's saying about legitimizing gambling, but the thing is, yeah, go ahead.
It was actually me, Gabby, that said that.
Oh.
Tika Ann didn't say it. Tika said the best way to describe it is a bet. And then I followed that with the comment, Tika Ann, I really see it as a way to legitimize gambling. And it is, but please continue.
No, it is. That's the best way to describe it. It is a bet. And this is why it's a little tricky, because some people will lose everything. They'll lose everything trying to play this game, but it's actual work. That's why I say it's gambling if you don't study. It's gambling if you don't know what you're doing. It's gambling if you don't study, if you don't pay attention when the company says how the company is doing, if you're not following the patterns of the chart. Like, there's a way of knowing more or less the way a stock is going to move. Like, there's a science behind it. And so you have to study that in order to know where it's going to go, right? So kind of, I guess you can say it's kind of like gambling, but not really, because it requires a lot more skill. I'm sorry, I can't hear you.
You're muted, Stephanie.
I'm so sorry. I have some questions on Facebook Live as to this point. So do you want to take the questions as you go or wait till the end?
I can take a question, yeah.
Okay. Sorry about that. So it's Judelia asked, what qualifies a person to get this right? Who are the calls placed to? Sorry.
Literally you and me in the market, right? So if I own the contract, I can sell it to you through obviously a brokerage account. So it's not personal. It's not like I'm buying yours personally, but you have people inside the market that are selling it for a price and you buy it for a price. So I'm going to go deeper into, I'm going to explain that in more in depth soon. I think in the next one or the one after.
Okay, and then one more question about this particular topic. Norma Stacy Roper Webster says, does the price of these contracts depend on the term?
Yes, actually. It does. Oftentimes, if it's farther out, it's more money because it's less risk.
Okay. Those are the questions. Thank you. Please continue.
All right. So you have calls. There are two different types of options. There are calls and there are puts. So no matter what direction the market goes in, you can make money. A call is when you believe a stock will go up. If it's at $5, you think it's going to go to $10. A put is if it's at $5, you think it's going to go to $2. So, you have to know what direction you think it's going to go in, and you have to know these terms, because when you actually go into the brokerage account, it's going to ask you, do you want to place a call? Do you want to place a put? So whether it goes up, whether it goes down, you can make money in the market. Okay, things to know. 1, you can sell before your expiration date. If you buy a contract saying everything that I said previously, and you see that it's not going in your favor, you can sell it to somebody else. You don't have to wait until the expiration date. In fact, you should sell it off. Or if you've already made money off of it, you can sell it as well. The only time where you can't sell it is past the expiration date because it's worthless. It's only good up until the expiration date. And also, you don't have to buy the 100 shares, which is called exercising your option. So just because you have the contract, it doesn't mean that you necessarily have to buy 100 shares, because some people don't have the money to purchase 100 shares of, of the stock. So that's why I said previously, you have the right, but you don't have the obligation to do so. Okay, so here's an example, because if you're in like a group or whatever, this is how they kind of talk. This is the lingo. So I'm in TWTR, which is Twitter, right? That's the ticker symbol for Twitter. The strike price is how much you think it's going to go to. So if it's at $68 and you think it's going to go to 70, you say Twitter, $70. It's a call, which means you think it's going to go up by July 16th, and 69 cents, that's how much you're paying for it. That's the premium, right? It can be a little confusing, which I'm going to explain. I made a short video that's I think is coming next to explain it, but it's not 69 cents means $69, because remember, you're getting 100 shares. So you have to times the 69 cents by 100. So when you purchase it in the system, it's going to say you're purchasing it for 69 cents, but it's $69, right? So I'm going to show you a video right now.
Make sure when you share the video, you should stop sharing and like optimize sound. So stop sharing now. And if you can, I don't know if that's gonna be a problem. Because when you share a video, you have to click those two boxes for optimize.
Okay.
And while you're doing that, we have a question. Stephanie, can you read the question?
The next question, Facebook Live, Judelia asks, what happens if no one wants to buy before the expiration date?
Well, you lose all your money.
Wow.
You have to, somebody has to buy it. Well, it depends, right? Because if they don't want to buy it, this probably won't happen. But if they don't want to buy it and you still have hit the price, right, then you've made money. So it doesn't really matter if someone buys it or doesn't buy it. If, of course, it is doing bad and nobody wants to buy it, then you can lose all your money. If nobody wants to buy it, it's probably really bad. Like you're in a bad place. You made a bad decision.
So it's open to the world. The option to buy from you is worldwide, right?
Exactly.
So someone's going to want to buy it.
Exactly. Normally, yes.
Okay.
So
you're looking to share your video. Okay.
You said to optimize the sound?
Yeah, take the two boxes at the bottom and place it.
Audio settings.
It's not settings. It's on the Zoom when you want to share.
Mm-hmm.
Before when it shows you that screen, the two boxes at the bottom.
Okay, I see it. All right, guys, so I'm going to show you how you would go about actually purchasing an options contract. Here, there's a long list of different stocks. I'm just going to go ahead and choose Apple because it's simple. Everyone knows Apple, right? So it currently says that it costs $148.36 in order to purchase a share of Apple. And so if I do my due diligence and I think it's going to hit $149, I can go and I can hit trade options. Here it's going to take me to choose what date I think that it should expire on. So whatever I choose, I'm saying I think that it's going to hit the price of $149 by this date. Also, I just want to say I'm utilizing the platform of Robinhood because it's simple to understand, not necessarily because I think it's the best platform for you to trade or to invest. But yes, let's go ahead and say I think that it's going to hit the price of $149 by July 16th. Then I'll go on here and I'll click that $149 call, and it's going to take me here. At the top, you choose the number of shares, not the number of shares, the number of contracts you want to purchase. And then on the bottom, you're going to choose your limit price. Now, your limit price is basically how much you're willing to pay for this contract. They give a suggestion. They say, like, in the market, it's being bought and sold for about this much, or we think it's worth about this much. But, well, they're saying here $26, right? But you don't necessarily have to pay that exact price. So you can put it for less if you think that somebody will buy it for less, or you could put it for more if you think that it's like a volatile stock and that it's going to go up really quickly. The price will go up really quickly. Also, it's important for you to look and pay attention because it says 26 cents, but on the bottom it says $26, and so that can be confusing. But you have to remember that you always have to put a multiplier of 100 because you can potentially obtain 100 shares. And so anytime it says that, it doesn't mean that it's only selling for 69 cents. It's always going to be, by a multiplier of 100. Here's another example. Here's Tesla. It's $671.11, right? Well, 15 now. So you go and you click and you choose the same date, July 16th, and you choose the prices you think it's going to be. And you can look at the price and see how it's drastically different. Like, it's drastically different if you are going to play the game of Tesla or play the game of Apple.
Why do you call it a game, Gabby?
All right, guys. It doesn't have to be a game, but it's just the colloquialism that came out at the moment.
I mean, but you call it that for a reason, because it's a risk. Is that why you're referring to it?
Well, yeah. There's definitely risk involved, but you say play the market, so I guess that's where I got it from. But yeah, there's a risk involved, definitely.
Like play the slots?
It's not gambling. I promise you, it's not gambling. But yeah. So sorry, let me go back. How do you make money if you don't exercise your option? So like I said, you have the ability to exercise your option, which means that you can sell it for 100. You can purchase 100 shares with it. However, like I said, you also don't necessarily have to purchase 100 shares. So how do you make money if you don't exercise your option? Well, the more there's an increase in the possibility that it will hit or pass the strike price, the more money you can sell the contract for. So what does that mean? If we go back here to this example, it's for $69, right? So that's how much you're paying for it. And so somebody else can get in, and because it's gotten higher, now the price of the contract can go up to $169 in the blink of an eye. It moves quickly sometimes. And so because of that, right, you can have the right information. You can say, the stock is saying, the charts are saying that Twitter is going up to $70 by July 16th. And you can be right about all of this. But if you choose a different premium, or you have to pay a different premium, then the amount of money that you're going to obtain if you choose to get out of it is less. So for example, again, if I'm in a group chat and I put this and I say, I'm in Twitter and this is all the information, and I bought it for $69, and somebody reads it and gets in after me, and by the time they get in, it's $169. They will make, even if it hits $70, they will make less money than me when we both sell it, right? Because they had to pay more in order to get in. And so two things. One, it doesn't necessarily have to hit 70 before the value of the contract goes up, right? The value of the contract goes up as it shows more and more signs that it is going to hit the strike price, but it doesn't necessarily have to hit the strike price. So that's how you make money. If you purchase it for $69 and you decide to sell it, and because it hits $169 and you decide to sell it, boom, you have $100. And that's if you bought one. If you bought 100 of them, then you have that times 100. So the more you put into it, the more contracts you buy, obviously, the more gains you'll have if you gain, and the more losses you'll have if you lose. But a lot of people don't necessarily exercise their right to purchase 100 shares. They do, and it's obviously a fantastic way to make money. But most people that are in the options sector make their money this way. So you'll purchase it for a set price, and if you get it at a good price, then you can make more money than someone who doesn't get in at the same price as you. Also, it can hit the 70 and start to go down, right? And so that's good for me if I got in at 69 and it goes up to 169, and as soon as somebody else gets in at 169, and the second they get in, it starts to go down. I have room, right? I can sell I have $100 of room to sell my contract and not lose that money. Whereas since they bought it at 169 and it's now worth less than 169, they will lose. So you can do all of the work and the due diligence, and you can know that it's going to hit something, but the premium is a big factor. You have to pay attention to both when purchasing.
There's a question from Princess. So does that mean you can set a time frame of when to purchase when it hits a specific price?
When to purchase when it hits it? Yes, you can. And you can also put a stop loss. So if you say if I lose 60% of what I put in, then it will automatically stop for you, depending on the brokerage. Or if you lose 20%, then it'll automatically put a stop loss for you, and you don't have to do anything. So, for example, if you're working, right, and you're not able to be on your phone paying attention to every single move that a stock makes during the day, you can just say, hey, I'm hoping that it does good. I think that it's going to do good based on what I studied, but if it doesn't, at least once it gets past 20% of what I put in, it will just pull me out. So yes. Now, fear and greed make markets move. This is important because it has to do with this, right? Some people will get in and they will make money. They'll make 100% of what they put in. They'll make 200, 500% of what they put in, and it won't be enough. They can think that they are going to go higher, that they can do better. And so because of that, they can lose everything because the market moves quickly. And so if you have made your profit, you're supposed to take your profit, right? If not, then you're being greedy and you can lose everything. In the same way, fear is also a bad thing because you can pull out too quickly, right? You can start and you can have done all the work and you know for sure that it's going to do what you said it's going to do. And I don't know, somebody tweets something and you get scared, and so you only make $5 profit and it goes up to $100. And so that's what makes markets move. Obviously, it has to do with the companies and how well they do and all of that. But on top of that, it's actual people that are in the market with emotions and feelings. And because of that, stocks go up and down, not necessarily solely based off of what is happening with the company or if it's a good company or not, but if people believe in the company or if people get scared or greedy. So that's important. And so do your due diligence. This is the most important thing. This is what separates it from gambling, because you will lose all your money. This is not like a stock. A stock, you purchase it, and let's say you purchase it at $5 and it goes down to $2, you can hold it for 6 months and wait for it to go back to $5, and that's fine because you own it. But with this, since there's an expiration date, you can't just say, oh, I'm going to just keep holding it and hope that it does better. You can, but if it's going against you, you need to be strong and say, I need to pull out because it's obviously not doing what I thought it would do. You also need to know how much you're willing to lose. And I say this because anything that you put into this, you should be willing to lose, which is why I suggest strongly that while this is fun, it's also, you have to be skilled and you have to really be invested in it. And so, and you can lose, like I'm saying, like that's the biggest lesson I want you guys to take. So my biggest recommendation is long-term investing. When you have, like, let's say you have a certain percentage of money that you're going to put into investing, have a large portion of it be long-term investing, do swing trading, which is, a less time, but still purchasing stocks, and then have a portion of it that's for options. And you work on it, you get good, because people make a lot of money on this. People are highly skilled doing this, and there are many ways to know what a stock is going to do. But you have to be cognizant of how much you're willing to lose, and you should be investing more money into things that are a little more safe, and you'll still make money, right? You'll still make money in those other
Gabby, to your point, Carol's comment is, Carol Medwinter Faulkner says, guys, you have to work with someone who fully understands the ins and outs of the market because it's very risky. Be willing to invest what you are willing to lose without being financially devastated. Thank you for that comment, Carol.
Yes, it's very, very true. I can't stress that enough. Because especially as you start learning, like, you guys can also learn on a paper account. So they have brokerage accounts where you don't have to put your real money in. They give you like fake money for you to learn on. And so you'll study the stocks and you'll study the charts, and it will be like the same platform, but it's a fake one. And so you can practice on that. TD Ameritrade has one on their Think or Swim platform, which I think is really great. I'm a big fan of that one. So you can always start without putting your actual money in, and you can pay attention and learn. I also recommend that. And I also recommend that you do swing trading first, because it's very similar. It's the same thing. The only difference is you're purchasing a stock instead of purchasing an option. And obviously the market is going to do the same thing with the stock as with the option, but your risk factor is a little different. So the potential for the money that's being made with options can be a lot more with investing less money. But if you start out with swing trading and you get the gist of it, and then you do a paper account, like, you should be able to work your way up. Don't just throw yourself into it. And create a plan and stick with it. Create a plan. Say, if it gets past this much, I'm pulling out. If I make this much, I'm going to stay in. You can't ask other people when you should pull out and when you should stay in, because their risk factor is different. They may have gotten in at a different price than you. They may have purchased their contract at a different price than you. They may have much more funds than you, or they may have less funds than you. So they'll be scared and they'll pull out when you can afford to lose more. So it's very personal. You can depend on other people to learn, and there's so much knowledge out there for free, and also like really cheap courses that give you so much information. But you have to know that at the end of the day, it's just you and the market. Don't depend on anyone else per se. And this is important as well, holding a contract over the weekend. So a lot of things can happen over the weekend. So when you choose your time frame, I'm not saying never do it. I've done it. I've held it over the weekend. But a lot of things can happen. So you want to make sure that you are in a relatively safe space, or that you're willing to lose a certain percentage if you do hold it over the weekend. This is, I think, the second to last slide.
I have a question. I've been raising my hand.
Oh, sorry, I can't see for some reason.
Because I'm kind of feeling like I'm catching it, but the basics I don't have. Like I'm thinking, your example of a stock being for $5 and you're predicting that it's going to be $10. Like, why don't you just buy the stock at $5? Why would you, like, I don't understand
Okay.
$5 at the time and you have the chance to buy it at $5. Why would I don't understand. Because then you're saying you have the option of buying it at the $10, it might go up to $20, but if you had bought it at $5, then you have $15.
Yeah, that's what swing trading is. So that's short term when you purchase the stock, and that's why I said it's literally the same thing except you're purchasing the stock instead of the option. So the thing about that is it's less growth. It's less potential for money for growth. So if you purchase an option, right? Let's say the stock could be $5 or it could be a Tesla or an Amazon that's a couple $1,000s, you know? And so if you purchase an options contract, maybe it's $200 and you can make way more than you would have if you just did swing trading, and you could invest less, right? Does that make sense?
I'm not getting it. So I'm not getting like how does it benefit a company for people to do this? And how does it benefit you? Like, I don't get it. I don't like what you're saying. Okay, I predict that it's going to go up to this amount. So go from the $5, take me to the what you predict. Like, how does that work in real life?
You can, but you can do both. Okay, so let me open back up the chart. All right. So what you're saying is you purchase right here and you think it's going to go up to $125, right? So you're saying, hey, just purchase it down here at $100 or down here nearly at $80 and just get the money, right? That's what you're saying? When it gets to $125, just take your profit?
No, I'm saying then you would have you would have bought it at the cheaper price rather than the $10 that you predicted or whatever.
Right. But it's just different. It's just different ways of making money. So let's say it's currently at this price, you sell it, you purchase it, a stock, right? You purchase a stock here, it goes up here, you sell it. That's swing trading. Options trading, you can do that. I said 5 and 10, but it could literally be $5 and $6. And when it goes up to 20, you've made not only the profit from it hitting $6, but everything up to $20. But it's not the actual stock. It's an option.
It's the right to buy it. Okay.
Exactly.
Buy it at that price. Okay.
Exactly. And also what you're making profit from is the value of the contract.
Right. And okay, so then because you froze it, let's say you froze it at that price, it's valuable because somebody would be willing to buy it from you.
Exactly.
Okay.
Exactly. So if I don't necessarily want to purchase the 100 shares, somebody else can. And it's already, it's looking like it's going to be what I said it would be. And so because of that, they're willing to pay a little bit more. And so I can make profit from selling it to them because their objective is to buy the 100 shares.
And my other question is, how is that benefiting the company? Like, is it because it makes people more willing to get in the game? Like, why? How does it benefit?
It's not about the company. It's literally just the investors. The company earns because people are buying and selling their stock. Their stock becomes a hot commodity. People want it, but it's about the investors. Okay.
Like, we're gonna be happy when SestraNow is on the market, you know?
Exactly.
You're not gonna say, oh, I don't know, what's in it for me? Why would I want to put this on the stock market? Why would I want people to buy my stock? We're just gonna all be very happy, right, ladies?
That's also an important thing. So like when you put stocks onto the market, that's for public people. But inside people, sometimes a company will give their employees shares, right? And so that's not publicly traded. And so they have a lockup period. So the company will say, I'm giving away shares because we value you as, you know, customers or for being part of this organization, and they're not allowed to sell it publicly for a certain amount of time. And so that can affect the market too. When that lockup period is over and they decide to sell it and take profit or not, one, there'll be a few more shares in the market for people to purchase, but also like it's going to change the stock a little bit. Okay, so the Greeks, we're winding down. The Greeks, this can be a little complicated. Some people, I've tried to explain it to some people and they don't seem to get it. So I'm going to try to do it as simple as possible so everyone understands. Greeks are basically, when you go to purchase a contract, the amount of money or the value of your contract can be established by many things, the volatility of the stock, you know, other factors. But the Greeks are a big factor in this. So you have delta. For every dollar that the stock goes up or down, you gain or lose the delta times 100. So if you look at this right here, if the stock goes up $1, then your contract, if you made $20 on it, for every dollar that it goes up, it's now going to make an additional $53, $53.96 for every dollar that it goes up. If it goes down, you're losing $53.96 for every dollar. Gamma affects the delta. So after one day, after you obtain this, right, you have to add the gamma to the delta, right? So by the next dollar, it shouldn't be 53.96. It's going to be 53.96 plus 8.75, right? So that's basically how the stock is going to move. And that's important because, you know, not the stock, the contract is going to be worth what it's going to be worth or not. And that's important because when you're looking at it, you can decide, hey, am I willing to risk a potential growth of $53.96 for a potential loss of $53.96? So you kind of know more or less what's going to happen based off of the Greeks. Then the theta. Everyone hates theta. Theta is time decay. Basically, the price decreases every day. Every day it's going to decrease $11, right? So you want your delta to be high and your gamma to be high because the longer you keep this, the less it's worth, right? Theta grows as the day goes by, as the days go by, as time goes by. So as you get closer and closer to the expiration date, the theta gets bigger and bigger. So that can be not a problem if the delta and the gamma are high, if the stock is moving a lot, if you're making, you know, it's dollar after dollar after dollar after dollar, and you're getting 53 and 53 and 53 and 53. But if it moves sideways, you don't want stocks to move. If you're in the option game, you do not want stocks to move sideways. If it goes up, that's good. You can buy an option. If it goes down, that's good. You can buy a put. If a stock moves sideways, the value of it will simply die out because theta is time decay. And so as the days go by, if the stock isn't moving up $1, if it's not moving up 50 cents or 20 cents, all you're doing is losing from the theta. Does that make sense?
Nope. I should have been on mute. I shouldn't have said that, but you know what? We're gonna have to do this again. And what does it mean to go sideways? What is that?
Okay, so again, to our handy dandy chart, I would say this is moving sideways, right? So it is going up a little bit, but for the most part, it's not. Like if you bought it here and you thought it was gonna hit, 500, well, I don't know, I guess here $580, and it's just moving right along on this $380 line. It's not doing anything. It's not profiting you.
It's stable though, no?
Yeah, but you don't want that's never good.
Okay.
It's never good because you don't want it to be stable. You want it to reach the price that you said that you wanted it to reach. And so when you buy an options contract, every day that passes, there's a theta, and so you're losing that amount of dollars every day, right? Regardless of what else happens. And that grows as you get closer to your expiration date. So you have your delta working against it, because if you have a high delta, it really doesn't matter to you losing $11. You're making $100 every day, So you don't want it to move sideways, because if it wasn't right here, if it was right here, it doesn't matter. You can lose $11 every single day. But this sort of uptrend means that your delta is probably going to be through the roof and you're going to make a ton of money. You don't make that if it's moving sideways, because that means you were wrong. That means it's not hitting $580. That means It's staying right here at 380.
Understood.
Okay.
Gotcha. Princess had a bunch of comments. Princess, you want to, so I don't misread what you wrote, do you want to make your comment now?
No, I was saying that with the earnings, when she was talking about earlier, why companies, for example, we know Apple is a good company, but then the share sometimes is based on how it's doing. So if they had a bad earnings, everybody's looking out to see what the earning per share is going to be at the end of the quarter. Did they make a profit or not? And if they put on an item and it didn't do well, then sometimes the shares drop and then people pull out. But then it's a good time to also buy it, because then that means the shares went down. So you can purchase at that price as opposed to selling, but it's always best to just stay in and not try to sell, because then it's a good company, Apple is good. So you just stay there and let it be long-term. But if you're looking to get something quickly, then sell, because they had a bad earning second quarter or third quarter, or whatever it may be. So that's what I was trying to say based on what you were saying earlier.
Right. Did everyone understand what she was saying?
Why are you guys laughing at me?
So
my question is, could we, because I want to apply what we learned practically, right? For SestraNow's mission and vision purposes, ultimately we want to have a SestraNow Women's Investment Group. Would you suggest we do that, pool our resources, and invest in option contracts, and do this so that we can all, the risk is spread out among us all instead of just one person, because it looks like you can make some money here, but I don't think individually anyone really wants to take that big risk. But if we all say, here goes 150 from me, 150 from you, and let's put this money in a pot and let's play with it, is this a good investment for a women's organization like ours?
It could be, if you're willing to take on the risk, if you're willing to understand what's happening, or if you find someone who knows what they're doing and can manage it, then yeah. But you could also do long-term investing as well, or you could do, swing trading. Those things are ways that are a little less riskier. I think the problem with options is people might be more stressed about what's happening with their money Whereas if you have a safer option, they would be more inclined to partake. But it's of course the way I make money the way anyone else makes money. You can do that. Yeah.
Thank you.
I just wanted to say something because when Gabby first offered to do this workshop, I thought it was more relating to companies. So I'm just putting here that stock options are a form of compensation. Companies can grant them to employees, contractors, consultants, and investors. These options, which are contracts, give an employee the right to buy or exercise a set of number of shares of the company's stock at a preset price known as the grant price. And so I'm just saying that, you know, for those of you, sometimes corporations, when you work for corporations, that's part of their compensation, part of your compensation packet. So it's, you know, I guess it's worth asking or worth knowing about. I don't know if they automatically, I don't think that they always automatically offer it, but when you're working, when you're starting a new job or something, it's a good thing to ask about it.
Yeah, I would agree. A lot of companies just have 401ks, but I think that if you're in a more I guess progressive company, or maybe more one that's more into finances, or I'm not sure, you can ask and find out what other opportunities they have. They might have options. They might have other things outside of a 401k. So you can always ask and find out.
You can also use that as a negotiating tactic in your interview. I've just learned that instead of asking for a raise or a bonus, you can ask do you have options, stock options? And that could be part of your negotiation in the hiring process.
Right. So, I mean, just piggybacking off of that, that's why, like, it's not necessarily always one person or individual people that are purchasing these contracts. Sometimes you have big companies that are purchasing it for all their employees. And so one move from them can change the way that the stock moves.
Yeah.
So, yeah. But anyway, there's also Vega and Roe. I'm not even going to get into them.
Never heard of that.
Yeah. They're, Vega has to do with like volatility. Roe is like really, you can research them if you want to, but the biggest ones are Delta and Gamma, Delta and Theta, and then Gamma.
So Gabby, you say we can research it ourselves. So how did you educate yourself on this market? Because I know you from, you were pretty much a baby. And so I know you haven't been around as long as we've been around. How do you get so smart with this stuff? So maybe we can read up and be just as smart. Can you tell us?
Social media?
You're making us look bad, Gabby.
Well, social media for one. There's actually a large platform of young people that are like,
there is. Yeah.
that are getting into it. And so if you follow certain people and they'll talk about it and they're excited and they're making TikToks about it, and I'm like, well, that's interesting. And so you can learn a lot just free on Instagram, on TikTok, YouTube University. I personally took 2 different courses. One I think was better than the other. It's this guy named Chris Johnson, and he broke it down really, really clear. So I just took one course and then I sort of researched the rest on my own. When I heard about Greeks, like I was in a group chat and they're like, be careful of the Greeks. Like y'all not paying attention to the Greeks. I'm like, what's the Greeks? And so I went to YouTube and I figured out what the Greeks are, you know? Or they have like quad witching, which is basically a time where the stocks are extremely volatile because they're expiring, like the contracts are expiring. So I was like, what's that? And I had to go and figure it out. So you can find a community, you can do social media, you can take courses. Like I said, most of them are way cheaper than I think what they're worth. Because it's just average people that learned about it and they're like, I want the world to know. So they're not interested in making a ton of money, you know? So that's how I did it. I'm still learning a lot, but
amazing. This is great. Thank you so much. And so are you wrapping it up, Gabby? We're at 8:00.
Mm-hmm. Yeah, I have one more, but
Okay.
it's not really. Just quickly, how do you know if a stock will move? You have news, you have earnings, like we were just talking about. So basically, when a company goes public, they have to be more transparent. And so after a certain period of time, they have to say what's going on with the company so that the investors know what's going on. You have indicators, so many indicators, RSI, simple moving average, MACD. There are people who say buy only at open and close because that's when there's the most value. That's when the most people are trading. You have support and resistance. These are just a ton of indicators. I told myself I wasn't going to get into this, and because this is just the beginners for options, but this is how you know how a stock will move, and this is how you change it from gambling to an educated guess on what will happen.
Amazing. Thank you so much, Gabby. Any questions before we wrap it up? Thank you so much, Gabby. Awesome presentation as usual.
There was one in the chat. I think Angie asked a question.
Can you read it, please?
I'm trying to find it now. Do you have information on where to go for paper investing?
For paper investing? Yeah. If you want to open up a TD Ameritrade account, you will automatically get access to their Thinkorswim. That's where you can do trading and investing, and they have a paper account there, just automatically. You don't even have to put any money into it. You can just open the account.
Where is this?
TD Ameritrade, the bank.
Okay. Okay. Oh, got you.
Okay. So it's called Thinkorswim.
Okay, again, thank you, Gabby, for an excellent presentation. Thank you, ladies, for joining us tonight. And so we like to watch our time. We're going to conclude this evening's Wednesday workshop and look forward to seeing you next week. And Annette, if you don't mind telling, what do we have for next week?
Next week, we're bringing back Integrate Your Plate, and we're traveling to Jamaica to learn how to do their national dish, ackee and saltfish. There's going to be some callaloo and bakes as well, and yellow yam.
We're not going to get to
Amazing.
taste it.
It sounds delicious. All right, on that note, we're going to say good night. We'll see you guys next week. Next week is SPS week. Don't forget, Sisters Promoting Sisters Week. So look out and please promote your sister by sharing the profiles to your personal social media. Good night, everyone.
Good night. Good job, Gabby.